Hi, I'm here with Steve Elliott, our tax technical director at MRZ, and we're going to talk a little bit about some tax relief changes that have come up lately that can help in the wake of several of the disasters that we've been having, including Hurricanes Harvey, Irma, and Maria, and also, as I understand, the California wildfires. So I know you have many questions, and Steve is here to help answer some of those questions. So I guess first, Steve, if you don't mind, let's jump in. And we've heard a lot about casualty losses and possibly being able to take some deductions if you've had any casualty losses. Can you explain what a casualty loss is and what people should know about taking advantage of a deduction related to casualty losses?
Sure. A casualty loss is a personal loss that's incurred after all receipts of insurance. So it's actually taken into consideration by looking at the value of property. A home, for example, lots of homes were damaged. I met a client today whose first floor was completely flooded in their two-story home. You take a look at the value of the property prior to the casualty and compare it to the value after the disaster happens. And you've taken into consideration a drop in value and you subtract out any insurance proceeds received. And to the extent that there's still a loss, that's a casualty loss. So it's personal use property, not business property, personal use property that drops in value, a net of insurance proceeds, and casualty losses are claimed on Schedule A, itemized deductions, and the only negative change that IRS put into place for these is they raised the floor from $100 to $500. So to the extent that the loss is greater than $500, after insurance, it's claimed as a casualty loss. The good news about the disaster relief for those that incurred a casualty loss is that the loss can be claimed on 2017's tax return, or it can be elected to be claimed on 2016. We have many clients that haven't filed the 2016 returns yet because we'll get into a little bit later about the deadlines that changed. But if somebody has already filed their 2016 return, they're able to amend it and claim the casualty loss in 2016. The key thing is, though, it would be better to wait to make sure that the known value is complete.
Okay. So the important things to know about a casualty loss is that it would be a personal loss. It needs to be in excess of $500 and not have been claimed or recouped from insurance.
Right. The other thing is that normally a casualty loss is subject to a 10% of adjusted gross income limitation. That's waived for the wildfires and all the hurricanes that happened.
Okay.
So the loss after insurance greater than $500, it's claimed as Schedule A, itemized deductions, and it can be claimed in 2017's return or 2016's return.